Ladies and gentlemen, welcome back to the channel. Markets started off today not looking great. It looked like it might be another really red day. Well, we got a speech from Fed Jerome Powell and a bunch of kind of new things from Powell that caused the markets to rebound a bit. We heard from a couple of Trump administration officials like Trade Representative Greer that it sounds like relations with China are getting a little bit better. There was a staff level meeting between US and Chinese officials that sounds like it went good. So, we're going to get into all of that in today's episode. But is the downside risk gone? How do you invest during this kind of a market? Is this the time to really start buying aggressive? Is this the time to use some margin? Is this the time to buy some protection? Maybe hedge out the portfolio a bit. Here in today's episode, we will be going over all of that. Okay, and we might get a little bit of an update on some of our favorite stocks as well towards the end of today's episode. Do me a quick favor, first things first, hit the like button as well as subscribe to the channel. Check that link out down below in the description of today's episode if you want to come join the trading community. Now, we did purchase another brand new stock today. What we do is we're going out there, we're finding opportunities in AI, software, energy, robotics, quantum, gene editing, like all of the main themes for the next 10 years, investing in the quality companies at great prices. That's it. It's as simple as that. Hard to identify the opportunities, but when you do, we capitalize on those. So come join us, link down below in the description of today's episode if you would like to. Our trading community portfolio is up 177.4% year to date. It was up at one point like 220% about a week ago, but again, like the last couple of days have been on the rougher side. This is not a recommendation. This is not financial advice. Returns are not guaranteed. You could lose money. Don't be a jackass if you join that. Understand that you are still responsible for your own investment decisions. But that link is down below if you guys would like to come join us. And let's get into all of your breaking news today. So we have a lot of exciting headlines from Jerome Powell, but I think what is a little bit more pressing is actually relations between the U.S. and China. So we'll start with some of those headlines first. Here we have U.S. Trade Representative Greer says Xi and Trump are still set to meet. There's a scheduled time. So they still plan on meeting each other. And that's part of maybe why markets bounced back today. Obviously, Powell had some things to say and that contributed to that, but headlines like this sound good. Greer says that he wants to make sure markets respond to appropriate info. Greer says we always watch the stock and bond markets. Greer says we have export controls we can impose if we need to. Greer says 100% U.S. tariffs on China could come sooner, depending on what China does next. Here you can see Greer says November 1st tariffs depend on what China does. Greer says Chinese realize they overstepped. Greer says it's hard for China to find an off-ramp on rare earths. Greer says that China's rare earth measures came out of nowhere. And Greer says China's rare earths measure is disproportionate. U.S. Trade Representative Greer says U.S. and China had staff-level talks in Washington on Monday. And U.S. Trade Representative Greer says we have had constructive talks with China over the past 6 months. So I think the fact that the U.S. and China are even talking to each other is something that the markets like to hear. Today, Trump named Kevin Hassett, Kevin Warsh, and Christopher Waller as top contenders to replace Jerome Powell in 2026. Treasury Secretary Scott Bessent later added Michelle Bowman and Rick Reeder. Hassett, a close Trump ally, is seen as the frontrunner for his pro-growth, low-rate stance, though some question his independence. And according to betting markets, Kevin Hassett is seen as, again, the likely runner-up at 41%, Kevin Warsh at 16%, and Christopher Waller at 15%. Citi's CEO says growth is cooling somewhat across the U.S. economy. JP Morgan CEO Jamie Dimon said today as well that the economy is on solid footing, quote-unquote, but could still weaken further. And after earnings today, Goldman Sachs is reportedly planning a round of layoffs. Now, good news is bank earnings across the board today came in stronger than expected. Here you can see JP Morgan says economy solid but downturn possible. JP Morgan's CFO Jeremy Barnum says the economy is currently stable with strong consumer spending and a resilient credit environment. However, growth is slowing and the labor market shows signs of softening. Quote, "It's easy to imagine the labor market deteriorating," he warns. Things being fine now doesn't guarantee they'll stay that way. So those are the biggest headlines that do not have to do with Powell. Now let's get into what Jerome Powell said today in his speech, because unlike last week's speech, Jerome Powell actually said some things that moved markets today. Jerome Powell says that tariffs increasing price pressure and downside risks to the U.S. job market have increased. Powell says right now there is no quote-unquote risk-free path for monetary policy. Powell says the outlook hasn't changed much since September's Fed meeting. So that's a really good thing for the markets to hear, because it basically means what Powell said in September, like nothing has changed. Now, we haven't gotten economic data. We are going to be getting the CPI report next week, but the 100% tariff threat with China hasn't changed Powell's approach to monetary policy. That sounds good. Fed Chair Powell says data prior to U.S. government shutdown indicated growth might exceed expectations. Powell says available data shows tariffs increasing price pressures. Powell says current Fed policy toolkit is working very well. This is really positive as well. Fed Powell says, quote, "may be approaching the end of balance sheet contraction in the coming months." So that means less of a selling pressure in the bond market, which that means, less support keeping rates higher. So it basically means that rates could be coming down as maybe the Fed stops selling assets onto the market. So basically what happens is the Fed has a bunch of assets on their balance sheet that expire, like 5-year bonds, 3-year bonds, 7-year bonds, 10-year bonds, whatever the number is. Well, what happens is part of the function the Fed has used over the past, call it since the global financial crisis, to keep rates low is buy bonds on the open market, because bond yields, long-term yields, are really a function of market demand, not Fed policy. So if the Fed has wanted rates to be low for 20 years, they've accumulated these assets on their balance sheet, as you can see here. Well, as they expire, they allow some of them to run off. So imagine in any given month, let's say for simple math's sake, 50 billion worth of 10-year bonds expire and would run off the balance sheet. Well, the Fed has been controlling that. So 50 billion run off, the Fed might go out and purchase 25 billion so that only 25 billion expire and run off the balance sheet, right? That is buying pressure and selling pressure into the open market. Well, bond yields have an inverse correlation. So more buyers of bonds mean lower rates, right? Because it's like a dividend stock. If you bought a 5% yielding dividend stock at $100 and the stock goes to $200, well, new buyers at $200 are now at a 2.5% yield, okay? If they're buying a stock at $200. Same thing is true in the bond market. So selling pressure in the bond market, as the Fed has been selling bonds into the marketplace, well, what does that do? That helps to keep rates higher, okay? Well, you could see how this could be very bullish for markets. And actually, the Fed's balance sheet tends to correlate to asset prices, right? As the balance sheet grows, asset prices tend to grow. as, the Fed's balance sheet falls, historically asset prices tend to reflect that. Okay. Well, the balance sheet has been falling since about 2022. And if that is about over with, then again, that's going to be less selling of assets into the marketplace, which should help actually rates fall on the long end of the curve. And Powell says that Fed officials will be discussing balance sheet composition. So what they own, what the duration is that they own, and what to keep, what to not keep in the coming months. Now, Fed Powell says the U.S. Central Bank has other data beyond government sources to use. So they're basically saying we're not in a complete blackout, that the Fed has some metrics to evaluate the economy and the labor market and what they should do as far as policy. And Powell says based on what they're seeing, nothing has really changed since September. That's a good thing to hear, that it doesn't look like we are plummeting into a recession, because that was the risk, right? If the government shut down for 3 months, a lot of pain could come in 3 months from an economic perspective, from a labor market perspective. If we're completely in the dark, then boom, 3 months later, we're surprised by that. Powell says there's things that they can look at to get a picture of, how the economy is going. Powell again reiterates that recent data indicates a low hire, low fire employment landscape. Powell says labor demand is moving a little faster than supply. Powell says we'll not try to pinpoint break-even rate of employment. Standard error itself is perhaps 50,000 per month. Powell says data since the July meeting shows labor market has softened considerably. Powell says as risks come more into balance, policy needed to move to being more neutral. Powell says labor market shows pretty significant downside risks. And Powell says research points to longer lags for policy to influence jobs and inflation. So again, it is a pretty weird market that we are in. There's no clear right decision here in what to do next. What I mean by that is we have no idea if tensions are going to get worse with China, if things are going to get better. Now, Donald Trump said in the past 48 hours, don't worry about China. Last time Trump basically said don't worry about China was the lows back in April for markets. Trump said to buy stocks. I mean, Trump saying don't worry about China is probably roughly equivalent to that. But things could get worse still from here before they get better. Like you've seen in the headlines, it really depends on what's China's next move, okay? And we don't know that. In this market, you need to be mentally and actually prepared for a crash. You need to be prepared for stocks to skyrocket into the end of the year. There's no clear best outcome here. Now, if you wanted to hedge your portfolio, since we bounced from the lows a little bit, that could make sense. It's not what I want to do right now, because I think the highest, most likely probability is trade tensions die down between the US and China. We get back to a market that is ripping higher. That's the most likely scenario. Now, again, we did have bank earnings today that blew away expectations. They came in really, really strong. Okay. Well, that's a good thing. As I've talked about before on this channel, I think Q3 earnings are going to be really good. I think earnings expectations for 2026 are going to move higher. That is what is going to help drive stocks higher. Okay. But first, we really have to get the China-US trade debacle solved. Once you get that solved, I think there's a lot of room for upside here, especially considering what we heard from Powell today. Powell said basically things are like unchanged from their September Fed meeting. And, the Fed has more access to data than we do. So if the Fed's saying that, basically it's like saying the markets are accurate pricing in two more rate cuts between now and the end of the year. Okay? That's basically the Fed saying they like what the markets are pricing in. That is a cut in October. That is a cut in December. And about 50-50 odds of another cut in January. Powell basically says that's spot on. Now, what Powell also said today about the balance sheet and potentially stopping the runoff of their balance sheet in the next couple of months, that also sounds really good. Okay, basically it could allow for yields to come lower on 10-year treasury yields, on the entire curve, really. Okay, the balance sheet affects the bond market a lot. So that also sounded good today. And generally, there's a lot of reasons to be excited about 2026. That's why stocks were doing so well. Well, you've got an injection of fear. People got all bared up quickly. If the whole risk of U.S.-China trade relations fall out again, like they get worse or they get better, that's really what's going to decide what happens next for markets. I think there's probably an 80+% chance that things get better before they get worse. I don't think Trump or China wants recession, large trade war, decoupling from one another. That's my bet, okay? So I am currently not hedging my portfolio, okay? What I'm doing instead is I'm buying on the red days. I'm legging into this market. The more we fall, the more I will buy. If we fall 10, 15, 20%, that's when I think margin makes a lot of sense. But right now I'm legging in as we have these red days if markets continue to fall. But I'm also holding a significant amount of cash ready to buy, again, if we do continue to fall. All it's really going to take is tariffs actually going into effect on November 1st. And you're going to have significantly more downside than where we are today. To some degree, markets are expecting there not to be a 100% tariff on China. I think if the markets really thought there was going to be a 100% tariff on China, stocks would already be substantially lower than where they are today. So, just my thoughts. Again, let me know your thoughts on all of this down below in the comment section. Some of our favorite stocks we talk about on this channel, like Resolve, up 2% today. Awesome. Poet, up almost 8%. Awesome. Okay. A lot of stocks are doing quite well today. So let me know your thoughts on all of this down below in the comment section. Ladies and gentlemen, have a great rest of your day, and I will see you in the next one.